Venture is a very strange, very small industry, and I think outside in looks quite peculiar. Yet it accounts for a very large percent of the public markets, even though less than 1% of companies started actually receive venture capital. What are the characteristics of companies that are perfectly suited as a receptor for the enzyme of venture capital? One is trying to understand a company or product on a scale of execution risk to market risk. And every company exists somewhere along the spectrum. An execution risk business is the market is very well understood. The demand for the thing is very well understood. And it's just a matter of delivering the product to the existing market. Nothing is really going to change dramatically about the shape of the demand. And it's just about meeting the demand with some amount of execution. If you are opening up the 7th McDonald's in LA, you're over here, and venture capital is not the right capital instrument for you. Primarily because futures are more certain. It would be much easier to raise debt or less expensive equity because of how de-risked the opportunity is. If you look at a company and it acquires companies and it pays back on 3, 4, 5, 6 month periods, you can look at that and say, okay, well, we're just going to finance the growth of this thing because we know with some level of predictability, it will pay back over some number of months. Equity is a really good instrument for financing businesses when futures are uncertain. There is max uncertainty when there is market risk. The more market risk, the more uncertainty about the future. And the more uncertainty about the future, the better that equity is the right instrument for financing. I consider market risk unknown demand. Let's take Airbnb, for example. Airbnb took market risk because it was unknown whether, one, people would want to sleep in the same house as somebody else, and two, whether or not people would want to sell availability in their homes to complete strangers. This was an unforeseen user behavior. Airbnb ventured forth, established this market where it didn't exist before. No one knew whether or not it was going to work. It was completely uncertain what the future would be. Venture capital is the perfect capital instrument for it. Companies like Facebook is another good example. It wasn't even clear how you would be able to monetize the social activity of college students. You had to assume that this product was going to be able to expand large enough and wide enough that there would be some monetization path available to it in the future. But in the short term, all you knew is that people were using it, and you had to hire people to continue to build the product. And you needed money to do that. It's a spectrum of execution risk and market risk. If you're over here, venture capital is perfect for you. If you're over here, debt is probably better for you. And if you're somewhere in here, maybe some combination of the two. Candidates for venture capital have excellent reasons for existing exactly when they exist. There needs to be a catalyst that enables a company to exist in a way that it was impossible to exist 5 years prior. More often than not, those companies were literally impossible to create 5 years prior. And it's only in that moment in time that that company could even come together from a technological or regulatory perspective. Companies that are there in the very beginning, as soon as it's created, are able to capture tremendous amounts of value. Companies that arrive too late are not able to create a lot of value. If you show up and half of the capturable enterprise value is gone after the first half-life and then 3/4 is gone after the second half-life, you're too late. At the time you have to make an investment decision, the why now for a company is almost never clear. It's very, very, very clear in the rear view. If you show up before it exists, and definitely if you leave before it is created, it's just as bad as being too late. Technology tends to be the most profound why now and the clearest lines between things that were impossible before and things that are then possible. Regulation does also tend to create these very bright lines between what was previously not in bounds and what is then in bounds. There are plenty of examples of companies that were impossible to create before a certain set of regulations were passed and were only then possible after a certain set of regulations were passed. All tech companies do not need to raise venture capital. The more predictable the future of your business is, the better debt is, as a financing mechanism, entrepreneurs up and down, across industries should really internalize something like that. Just because TechCrunch exists, just because venture capital is romantic or sexy, doesn't mean it's the right capital instrument to finance the growth of your business. I would argue that a lot of these like direct-to-consumer e-commerce companies were not really good candidates for venture capital. First of all, you have revenue from day one. I think there are a lot of things in venture capital that have to go years without collecting their first dollar of revenue. And so if you're building a product, you're selling it to people, you can use that revenue to finance your growth. You don't need venture capital to bootstrap this thing off the ground. I think a lot of these direct-to-consumer e-commerce businesses were closer to execution risk than they were market risk. I think it's one of the reasons why you can see a lot of them struggle, especially the ones that have raised venture capital, because they had significant pressure put on them to grow, perhaps faster and more unnaturally than they would have had they grown organically. I do think that venture capital on the margin is capable of foie gras-ing businesses with money, especially businesses that either don't need the money or already have enough of it. Venture capital is like rocket fuel. It's great if you have a rocket, and if you try to put it in a car, you destroy your car. It's not just like inert, it's actually actively harmful because the pressure associated with taking that money may actually put that company on a trajectory that is net negative than had it been unbounded by and unburdened. Debt is a very good capital instrument when futures are certain. The more clear and certain financial futures are, and futures in general are, the more predictable they are, the better debt is as a capitalizing instrument. Equity is perfect for venture capital because futures are very uncertain. It allows companies, in some ways, to reach forward in time and catalyze their growth and compress, what might have taken 20 years of organic growth into 5 or 10 years of compressed growth. A lot of the time, the resources that you can invest into building the company, hiring the people, you are limited by the cash that you have on hand available. And the error bars that are permissible with equity are much wider than the error bars that are permissible with debt. So total addressable market is a really important concept because it establishes the denominator over which you as a business can expand. There are businesses that have very low or small total addressable markets. And because they have a small addressable denominator, there's an intrinsic limit to the size that company can grow to. Low TAM can often rule out potential opportunities. But it's worth noting that some of the examples of the most successful venture outcomes of all time are when people dramatically underestimate the size of the terminal total addressable market. Quintessential classic examples of venture capital, they happen because we dramatically underestimate the addressable market of that product. You try to size the market for Uber. You would look at proxies like we have yellow cabs in New York, and that'd be probably pretty sizable. And so in and of itself, that would probably establish the argument for it. What people totally underestimated was how much latent demand there was for a product like this and how much more usage of a product like this would occur when it was more accessible. So if you were to say at the very beginning of peer-to-peer ride sharing that it would drive car ownership down, some people would be like, that is insane. That's like an insane conclusion to come to, but it's absolutely the truth. By solving the coordination problem and lowering the friction and effectively the coordination cost and ultimate cost associated with it, usage goes way up, because the cost associated with consumption is significantly lower. Even a sophisticated best estimate of its total addressable market is a vanishingly small accurate estimate of its total terminal addressable market.